Have you ever wondered what is a K-1 and how do you get one? We're going to dive into that into this video. My name is Tim Kraus. I'm the operations partner with Cornerstone CPA, and let's dive into the topic of what is a K-1. So, first off, what is a K-1? A K-1 in accounting speak is a tax form that reports the individual's share of the income or deductions from a pass-through entity. So that's not a C Corp, which is one of the really only ones that's not a pass-through. Pass-through entities are partnerships, S Corps, and trusts if you have multiple members. What does that mean in normal language here? So if you have an actual business, like one of these pass-through entities, you have a partnership up here. And let's say you have multiple partners within that partnership. Let's just make it 2 for easy. Make it easy right now. Okay. The tax liability passes through the partnership and goes to the individual partners, thus the pass-through. So then this person over on the right here, let's say that each partner got $50,000 in profit. Now that $50,000 would be added to that each individual's gross income and then be taxed at the appropriate tax brackets for that situation. But the tax passes through, or the deductions pass through, especially if there's losses, or the credits pass through the entity and actually fall onto the individual. From a tax perspective, that's how the government looks at these. So the K-1, bringing it back to the K-1 again, the K-1 lets the government know how much of the income or deductions or credits go to each individual versus, or so they know who is actually going to be paying the tax or who's going to be getting the deduction at the end of the day. This is what the K-1 form looks like. You won't be filling this out. Whoever does your taxes will be filling this out. This one, again, comes from a partnership return. That's the 1065 number is a partnership return. And then it has whether it's income, what sorts of income is it, dividends, royalties. It has a whole bunch of types of information here that will then fall onto your personal return because it passed through that first entity, in this example again being a partnership. So who gets a K-1? The partners in the partnership, anyone who's going to be receiving the benefits, whether they're positive or whether they're negative, the losses from the actual partnership and or S Corp, and then also trusts and estates with beneficiaries entitled to the income or distribution. So that's who gets a K-1. So if you have multiple partners, if you did a real estate deal and you and someone else partnered on a deal, and one of you did all the work and one of you brought all the money and you are partners in the deal, then both of you will be getting a K-1 when that business has a profit and or a loss. So what's on the K-1? The important part here, and I really want you to pay attention to, is your share of the income, your share of the deductions, also your share of the tax credits, and your share of the ownership. The K-1s will be individual to the person receiving the K-1. They'll be from the business, but let's say that one person owns 25% and another person owns 75%. The K-1s will be different depending on how much ownership there is in by each partner. And actually that could then go to the K-1, which then get taxed again at their personal return, because that gets added to your normal one, and then you fall in the progressive tax brackets, and then that whole fun song and dance there. So how do you get a K-1? We get this question all the time. The K-1 comes from the return, whether it's a partnership return, an S Corp return, or trust and estates, but it comes from the return. So we cannot, no one can make a K-1 just by itself. So if you're asking an accountant or a tax professional, hey, can you make me a K-1? They'll say, hey, we need to actually do your partner return or your S Corp return to actually make that happen. For the businesses, for the partnerships and S Corps, their non-extension deadline is March 15th. And then for the trusts and estates, their non-extension deadline is April 15th. If they go on extension, then the one for S Corps turns to September 15th, and the ones for trust and estates turns to October 15th. If you have a partnership or an S Corp, it is really great to try to not go on extension unless all of your partners are okay with it, because you're going to be delaying them, and it kind of turns into a big mess there. We're going to go over that in just a second here. And however they'll be sent to you, a lot of times they're electronically sent. Technically old school, you can get mailed a K-1, and then you will give it to your tax provider who's ever doing your personal return. So if you don't get a K-1, first off, make sure you file an extension. The 4868 is for your personal tax return extension. Just tell your tax provider, hey, I'm waiting on some documents, so we're going to have to go on extension. And then if you still don't get a K-1, it's better to file without it than it is to not file. I have a video on extensions that goes over the different sorts of penalties the IRS has for late paying and then also not filing. And then if you're going to if you are going to file without it, try to do the best you can on the estimate. Again, if they give you no information, this is going to be really tough. And then you will have to amend this return later when you actually get your K-1, which is a bummer, but also not super uncommon because some businesses are really delayed with sending out their K-1s. So best case scenario, you don't need to do an extension, but if you do, make sure to still file because the penalties are less than if you don't file at all. So do CPAs prepare K-1s? Yes, CPAs do prepare K-1s. My partner is a CPA, and we do a lot of K-1s. We do, right now, what are we doing, 30? We probably do 30 returns, 30, 40 returns that have K-1s that we send off for people. So yeah, we do that as part of, as part of the actual finishing up the returns. Technically, the business can, if the business doing its own taxes. Not very common, but oftentimes, we make the K-1s as part of the return we're doing. So, key takeaways here: the K-1 is a report of your share of how the business did, whether it's income deductions, credits, or past or all those things. It's just a report letting the government know, hey, from this profit from the business, it went onto my personal return. The business itself does not pay the tax because it goes into your personal return. Then you pay the tax on your personal return. Now, again, you could use business money to pay it. We're not going to get into that, but it technically goes onto your return individually. And you are definitely 100% required to report this K-1. If you do not, on your personal return, report a K-1, and the business files its return and does K-1s, you will get an ASTIgram that you failed to report income, which is not legal to fail to report income. So hopefully when you get your K-1s, you will get them by the deadlines. Hopefully the business will turn the information so then we could process all that and make the tax returns and send them right off. If you're missing the K-1s, please make sure that you file an extension. That will give them at least 5 months to get their stuff squared away and you 6 months to then file again. And then your CPAs can help you interpret the K-1s. They're pretty straightforward. But we do prepare, but don't prepare forms unless we're working on the issuing entity, yes. So we have to be doing the actual return for the pass-through entity, for the partnership, for the S-Corp, in order for us actually to make the K-1. We cannot make them by themselves because that's like asking for the answer to a question without the rest of the math to actually get to the answer. We can't just make that up. It's not how it works. So if you still have questions about K-1s or tax filings, please put them down below in the comments. And here is, again, what this looks like from a few things we talked about already. Here is going to be the information for the actual business. So in this one, it is a partnership. A 1065 is a partnership. So the partner's information, or the partnership's information. And then your information down here as the partner in part 2. And a whole bunch of information potentially about you in here. And then the partner's share of the deductions, credits, income. What's the information that's going to go from here onto your personal return? And again, your CPA, your tax preparer, will fill this all out for you and then have it transfer properly to your personal tax return. So my name is Tim with Cornerstone CPA. I'm the operations partner. We do bookkeeping, tax, and tax planning. If you have any questions or would like to reach out, please do. Have a good one. Bye.